Right now, let's talk about an interview on Face the Nation with the president of the Federal Reserve Bank of Minneapolis. That's Neel Kashkari. He said the banking system is sound. He says, though, it's too soon to know the effect that the Silicon Valley bank failure will have on inflation and the economy. Kashkari also called for a regulatory system that ensures the soundness of the banking system and helps community and regional banks to thrive. So those recent swings in the Treasury market could be a bad sign for the economy, some people say. Earlier this month, yields saw their biggest plunge since 1982. So for more on this, let's bring in Joe Rennison. He's a markets reporter for the New York Times. So, Joe, you could hear in that intro, that long intro, we sort of gave the tale of two, there's sort of two sides of that coin, right? Where some, like Neel Kashkari, say banking is sound, which seems to have alleviated some fears in the market as far as it relates to this morning, but there are still longer-term fears of a recession down the line. So what is this? How does this bond trading, for people who are trying to understand this, how does that correlate to a decline in the economy?
Sure thing. Yeah. So kind of as you were pointing out at the top of the, just after the break, equity markets this morning are reacting quite positively to the news around SVB, and we're seeing them rally a little bit. We saw that last week as well. We saw it the week before. To look at the equity market would seem like a lot of the consternation, a lot of the fear around the nation's banks is kind of dissipating somewhat. But to look at the bond market, the movement there, the change in price, the change in yield up and down has been some of the most volatile movements we've had in decades. And the reason is because what's happened with the country's banks is now not only being thought of in the context of the banking sector, but it's being thought of in the context of what has the Federal Reserve's campaign to raise interest rates done on the wider economy. What's it going to do to the outlook for the economy going forwards? And certainly the bond market, not the equity market, but the bond market is certainly signaling that a lot of traders are a little bit worried about what's to come.
I want to sort of get your take on the Federal Reserve, Minneapolis Federal Reserve Chair Kashkari saying that, you know, the banking system is sound, which we've heard over and over again. But I think sort of as an outsider, as somebody who doesn't know anything about this, what I see are a bunch of last-minute negotiations to ensure the soundness of the banking industry, or at least of some banks, several banks. And that doesn't make me feel comfortable with the soundness of the banking system. Is this how it's supposed to work? That there are last-minute sort of negotiations, 11th hour negotiations that prop up smaller banks?
So I can understand from the outside why that seems concerning, disconcerting, a little bit worrying, perhaps. The banking system in the US, the banking system in Europe as well, is certainly in a much more solid, sound place than it was in 2008. The capital requirements, essentially the cushion, the buffer that these banks have to hold to protect themselves if they get into these sort of stress situations, is much, much higher now. And yet, we're still seeing in some instances, collapse, in other instances, weakness of banks around the country. And that's sort of tells us more in a way about the psychology of what is happening right now. That kind of, when that fear kind of spills out, when it becomes more widespread, it's very hard to contain that. It doesn't really matter how big the cushion is. If everyone is asking for their money back from a bank at the same time, there isn't a bank in the world that is able to withstand that. That's just kind of the way the system is set up. There isn't very much that can be done to limit that unless regulators come in and try to prop up and try to support in the way that they've done, in the way the FDIC has done, in the way the Fed and Treasury have also done. And so there is some aspect of this which is almost unavoidable once that fear becomes entrenched. But it's not entirely incongruous for Fed governors to still be sort of asserting the soundness of the banking system.
Joe, because this is your beat, and once again, I'll reiterate that I don't know much about this. You know, it occurs to me that part of what happened was just the way in which we communicate now, that we have the ability to communicate much more rapidly. And so once one group of people started to get concerned about their money, it spread like wildfire. And I wonder if there is any discussion, whether it's among regulators or others, about ways in which to manage this kind of emotional reaction in an era where, you know, a rumor or a concern can spread around the globe in seconds.
Where people will start withdrawing their funds because of something that happens at a regional bank that they don't bank with, but then they look at their small regional bank and say, you know what? We might be next, so I'm going to pull my money out, and then all of a sudden there's a run on these banks.
We're at risk of this sort of frenzy in a way that we never have had. We never had not. Can I speak properly for a second? Sorry,
Monday.
It's Monday. We haven't been at risk like this before, just because of the nature of the internet and the way we communicate so quickly.
It's certainly different, isn't it? I mean, the images out of 2008 were of people lined around the block, waiting to get their deposits out, you know, queuing to ask a teller for their cash, rather than going on their mobile phone immediately and being able to move money around within a matter of seconds. It's a different environment, and you're right, it amplifies the dynamics that some of these banks are facing, the withdrawals and the speed of withdrawals that were coming out of SVB and Signature were unprecedented. And that idea that we all expect to be able to get our money instantaneously, whilst a bank might have to go and find that money that it's put in various different places to keep it safe, to lend it out, to give mortgages, to give credit cards, all these sorts of things, it takes a little bit longer on their side than maybe what our expectations are for when we can get our money. And that disconnect is what creates these situations where, you know, SVB or Signature became very stressed very, very quickly, despite that kind of concern not being there, you know, even days before this sort of crisis erupted.
Right. That makes a lot of sense. And it makes me concerned about, you know, just how volatile things could go and can get in the future. Hey, Joe, it's great talking to you. Joe Rennison.
Thank you.